You can make a completely normal retirement move, the kind that's in every money checklist, and still end up with a tax surprise because one number moved, your income. Here's the promise for this video. By the end, you'll be able to spot the 3 income-too-high tripwires that change how IRA contributions are treated, and you'll know exactly what to check so you don't discover the problem after you file. Quick note up front, this is education, not personal financial or tax advice. Rules change over time, so today is about the mechanism and the checks. Let's use one realistic example the whole way through. Meet Maya. Salary job, a performance bonus, and a small side gig that can swing. In January, she sets up automatic monthly IRA contributions. Nothing fancy, just consistent. Then late in the year, her bonus is bigger than expected, and the side gig had a strong run. Her day-to-day life doesn't suddenly feel rich, but her year-end total income moves. And that's where the income-too-high trap lives. Most retirement tax perks don't turn off with a loud alarm. They fade out through phase-outs, or flip based on workplace plan coverage, or turn into a paperwork problem called an excess contribution. Tripwire 1. The contribution is allowed, but the tax break you assumed is not. This is the classic traditional IRA confusion. People hear traditional IRA is tax deductible and treat that like a universal rule. In reality, deductibility can depend on your income and whether you or your spouse is covered by a workplace retirement plan. So Maya contributes to a traditional IRA thinking, cool, this reduces my taxable income. But she is covered by her employer's 401k. That workplace coverage is a switch that can change the rules. Mechanism-wise, you can still contribute, but your ability to deduct that contribution can phase out as income rises. If you are above the phase-out, the contribution becomes non-deductible. It still sits inside an IRA, but you did not get the upfront deduction you expected. The practical punchline is that 2 people can each put the same dollars into a traditional IRA, and only one of them gets a deduction. The other person has a non-deductible basis that needs to be tracked on the tax side. If that basis is not tracked, it can turn into accidental double taxation later. Tripwire 2. The contribution is not allowed the way you did it, and now it's an excess. This one hits when someone contributes to a Roth IRA directly, then later realizes their income ended up above the limit for the year. Notice the timing problem. Maya set her contribution in January. She didn't know what her final year income would be. Bonuses, overtime, commissions, side income, and sometimes even investment income can shift the total late. If her final income ends up above the threshold for a direct Roth contribution, the money already put in can become an excess contribution for that year. Excess contributions are the kind of problem that can keep generating penalties until it is corrected. The exact path depends on timing and how it is fixed, but the big point is simple. You want to catch it early. Also, this trap isn't just for high earners in the way people picture it. The limit is based on a specific definition of income used for these rules, not just base salary. It is very possible to feel normal financially and still cross the line in a year with a large bonus or a spouse's income shift. Tripwire 3. You try a popular workaround, but you accidentally trigger the pro rata rule. If Maya learns she can't contribute to a Roth directly, she might hear about the backdoor Roth idea. At a high level, that is a non-deductible traditional IRA contribution followed by a conversion to Roth. Here's the part people miss. The IRS often does not look at each IRA as a separate bucket for that conversion tax math. It frequently treats all of your traditional, rollover, SEP, and simple IRAs as one combined pool when it calculates how much of a conversion is taxable. That is the pro rata rule. So if Maya already has a pre-tax rollover IRA from an old job sitting somewhere, a conversion can become partly taxable even if the new contribution itself was non-deductible. People think they are converting the new money. The calculation sees the whole pool. Now, go back to Maya in October. She checks her IRA app and feels good. Contributions are happening. She is being responsible. But behind the scenes, 3 things are changing. Her year-end income estimate is rising. Her workplace plan coverage switch is still on, and an old rollover IRA she forgot about can matter if she uses a conversion strategy. None of those show up as a big red warning where she sees the contribution happen. That's why people get caught. Here's a quick numbers-only way to see why this matters. If Maya puts, say, $6,000 into a traditional IRA, assuming it is deductible, and it turns out to be non-deductible, the difference is not tiny. If her marginal tax rate is around 20% to 30%, that mistaken assumption can swing her tax bill by roughly $1,200 to $1,800 for the year. Not because she did something wrong, just because the benefit she expected was never there. On the Roth side, the pain is often the penalty clock. Excess contributions can be hit with a 6% excise tax per year while the excess remains. On a $6,000 excess, that's $360 per year until it's corrected. The dollar amount is not the worst part. The worst part is discovering it late and realizing it has been stacking. And on the conversion side, the pro rata surprise is a classic "wait what" moment. You might expect the conversion to be mostly non-taxable because you just made a non-deductible contribution. But if you have a large pre-tax IRA balance, the taxable portion can be much higher than you assumed. So the goal is not to memorize income thresholds. The goal is to know which switches exist, and to build a simple habit of checking the right screens before you accidentally create cleanup work. In the next part, we'll turn this into 3 concrete signals you can watch during the year, plus a simple decision table of what options people commonly consider, depending on their timeline and how close they are to the line. Let's make this actionable with exactly 3 signals to watch, all year, without turning your life into a tax spreadsheet. Signal 1. Your year-end income estimate is drifting up faster than you think. You don't need a perfect forecast. You just need a rolling estimate that includes the stuff that shows up late. Bonus, overtime, commissions, side gig profit, and for some people, investment income that isn't obvious until tax forms arrive. What to look at: your last pay stub of each month, specifically the year-to-date totals, and any bonus or commission tracker your employer uses. If you have side income, look at your last 30 days of deposits and your last 30 days of business expenses. You're not doing taxes, you're checking direction. What the direction means: if your year-to-date total is running ahead of last year, and you have known lumpy income later, you're moving toward the zone where IRA treatment can change. Typical timing. For most people, the biggest error happens in the last quarter, when bonus and holiday season income hits. That's when the trap snaps shut. Back to Maya. She sees her year-to-date pay is already above where it was last year, and her bonus target is higher. That's her cue to pause the autopilot assumption, not necessarily the contribution. Signal 2. Whether you or your spouse are covered by a workplace retirement plan. This sounds too basic, but it's the switch that changes the deductibility story for a traditional IRA in many situations. What to look at: your year-end benefits summary, or your W-2 Box 13, which often indicates retirement plan participation. Also, if you change jobs mid-year, you might have coverage in one portion of the year that still counts. What the direction means: if you have workplace coverage, you should treat traditional IRA equals tax deduction as a question, not a fact. It can still be a great move, but the benefit may be different than you assume. Typical timing: job changes and mid-year benefit enrollment are when people get this wrong because they mentally file the year as before job and after job, while the tax rule sees the whole year. Maya has a 401k all year. That puts her squarely in the category where deductibility may phase out, depending on where her final income lands. Signal 3. The size of your pre-tax IRA pool if you're considering a conversion strategy. This is the pro rata landmine. If you have a rollover IRA from an old 401k, or a traditional IRA with pre-tax money, it can affect how taxable a conversion becomes. What to look at: your IRA statements, especially the year-end value, and whether the account is pre-tax, non-deductible basis, or mixed. If you don't know, the simplest starting point is: do you have any traditional, rollover, SEP, or simple IRA balances right now? What the direction means: a bigger pre-tax IRA balance generally increases the taxable share of a conversion. The conversion might still be worth it for some people, but you want to know the tax shape before you pull the lever. Typical timing: this becomes urgent when people do a last-minute fix in March or April and convert without realizing they just created a taxable event. Now, what do you do with these signals? Not advice, just the decision table people commonly use. If you are clearly below the income line and you want the simplest path, autopilot contributions can be fine, but you still confirm signal 2, so you don't assume a deduction that may not apply. If you are near the line and your income is volatile, you might prefer to delay final IRA decisions until later in the year, or contribute in a way that's easier to correct. Some people keep contributions in cash inside the account until they're sure, so the correction math is cleaner if needed. If you are above the line for a direct Roth contribution, options people explore include a non-deductible traditional IRA contribution and then converting, but only after checking signal 3, because the pro rata rule is what turns this from clean to complicated. And if you already contributed and later realize the treatment is wrong, the key variable is speed. The earlier you catch it, the cleaner the correction tends to be. Waiting until after filing can turn a simple adjustment into a multi-step cleanup. Let's end with a 2-minute checklist. These are concrete screens and documents, not vibes. 1. Pull your last pay stub and read the year-to-date earnings and tax lines. Take a screenshot so you can compare month to month. 2. Confirm workplace plan coverage. Check your benefits portal or your W-2 box 13 when it arrives. 3. List every IRA you have. Traditional, rollover, SEP, simple. If you're not sure, check your brokerage dashboard for account types. 4. If you contributed to a traditional IRA, find out whether it was intended deductible or non-deductible. If you don't know, treat that as a red flag and clarify before filing. 5. If you contributed to a Roth IRA, do a quick year-end income estimate and flag it if you're near a threshold, especially if you have a big bonus or side income. 6. If you're thinking about a conversion, look at the total pre-tax IRA pool first, so you don't get surprised by taxable pro rata math. If you do just those 6 things, you stop the income too high trap from being a nasty surprise and turn it into a predictable system. Maya's big win isn't avoiding complexity forever. It's catching the switches early enough that she still gets the benefit she intended without the cleanup. If this helped, subscribe to the Wealth Blueprint for more clear money breakdowns, and leave a comment with the next topic you want covered, or the one part of today's video you want explained even simpler